Well, when Alan asked if I'd like to speak at this statistics conference about financial risk, I basically first thought, what's the most controversial title I can possibly come up with? And this is it, Abusing Statistics in Retail Banks and its Contribution to the Banking Crisis. And at first it might sound a bit of a dramatic title, but actually it's based on sort of real experiences, real world examples of how sort of overlooking of fundamentals at banks has sort of really genuinely contributed to their downfall. So before I sort of go into any examples or anything, I want to give you a bit of background to myself. I work at an economic consultancy based in London, and we provide a lot of support. We have provided a lot of support over the last 4 or 5 years to banks and building societies, and specifically in their credit risk departments. So we've sort of got a good experience in this field. We've worked with some of the big players, people like Nationwide Building Society, Lloyds Banking Group, formerly HBOS, and Lloyds TSB. We've also worked with some of the sadly less successful banks of recent times, like Bradford and Bingley and Northern Rock. So we've really got experience across the field from some of the ones that have survived and some have really not survived. And the two examples I'm sort of going to present are very much based on standard industry practices. They're not sort of focused from any one of these specific banks, but they're examples of where, as I was saying before, the fundamentals have really sort of been overlooked in getting to the results they wanted. So before I can sort of get deep into those examples, I need to give you a little bit of background to credit risk. As Alan mentioned, Basel II. I'll come on to that in a minute. But the key thing that I'm discussing here is capital and provisions, specifically capital. So what are these two things? Well, they're basically a big pot of money that's put aside against losses. And those losses can either be sort of short-term forecast losses, so what the bank thinks it might lose, or it might be, in terms of capital, a bigger reserve for a worst-case scenario, so for example, like a recession. And the losses I'm talking about are here retail losses. So this is on lending that's made by the banks to people like me and you in the form of mortgages, credit cards, loans, overdrafts, that type of lending, consumer lending. And it's when we default on those loans that the banks make losses and why they need to hold provisions and capital. Now, provisions obviously can be difficult to forecast. Typically, it's predicted based on recent experiences. So people will say, how much did I lose last year? How much might I lose next year? Capital, it can be a lot harder to estimate, because obviously we're not permanently in a recession. We don't know how much we're going to lose on our portfolio should a recession come around. So capital is the trickier one to calculate. And it's the miscalculation of capital which, to an extent, certainly contributed to the downfall of various banks. People are aware of things like exposure to US subprime investments. But raising capital at the last minute when they realised it was too small, the amounts they had was too small, certainly contributed to the downfall of several of the banks in the UK. So a bit more about capital calculation again before I come on to the examples. The regulation for capital calculation comes from the FSA in the UK. And actually more widely, it comes from a set of international regulation known as Basel II, as Alan mentioned. And most of the banks in the UK have opted for what's known as the internal ratings-based approach to capital calculation. And this is basically the more complex option for them. And what it allows them to do is to estimate how much capital they should be holding based on their own experiences and their own calculations, rather than using sort of standard industry ratios, if you like. And since the sort of inception of Basel II, sort of 4 or 5 years ago, the FSA has been keen for banks, for retail capital, to calculate this at an individual account level. So if I have a mortgage with a bank, The FSA wants them to be able to calculate how much money they should put aside for the worst case scenario, just in case on the unlikely event I default on my mortgage. Now, obviously, one of the key components of the modelling exercise, therefore, that the banks have to do is to calculate the sort of probabilities of default, as they name. So the likelihood that individuals will sort of fail on their lending. So by default here, I mean falling into arrears basically to a position, so getting behind on your payments to a position where you're unlikely to repay the loan at full at any point in the future. Now, it's obviously important, if you're going to calculate your capital correctly, that you can try and calculate these probabilities of default, as they're known, correctly for individuals that you are lending to. And it's basically a desire to overcomplicate and try and accurately model PD at an account level, which is where sort of the fallacies lie, if you like, in their calculations. So I'll start with a chart. I can't obviously give you any sort of real banking data. It's all, sadly, far too highly confidential, and I'm sure they wouldn't be very happy if I revealed it. But what I can show you is sort of industry data. And this chart shows the percentage of UK mortgages through time that have fallen between 6 and 12 months behind on their payments. So you can see that prior to the last recession of the early 1990s, that was about 0.5% of the market that was in that position, so very low, relatively speaking. That rose during the last recession and peaked just after, so it quadrupled, went up to around 2%, and has subsequently been sort of falling ever since. So it became a lot safer in the early noughties, and you can see that it's beginning to rise again as we started to go into recession in 2008. So capital is all about really putting aside enough money so that if your default rate on your portfolio, if the number of people defaulting starts to rise dramatically, that you've actually got enough money to cover those losses, like that peak in the early 1990s. So that's a sort of a time series view of the world, but as I mentioned before, the FSA was keen, and was up until fairly recently keen, that the modelling should be done at an account level. Now, the two outcomes for a person, if you're modelling them, are just good and bad. So whether or not you do fall into arrears and default in the future, or whether or not you do not fall into arrears and don't default. So they're usually called good and bad. And so the obvious choice for modelling this is a logistic regression. And that is indeed the approach that is used. And it tends to be at a single sort of point in time that the modelling is performed. So what the banks do is they take a sample of accounts from a portfolio, say a mortgage portfolio. They will look to see take everybody who is not in default at that point of observation. They will look 1 year forward, and they will try and then they'll see which people do default during that year and which people don't default, and that gives them the 0-1 outcome. Now, so that's the dependent variable. The independent variables come from many sources. They've got sort of internal data, things like an application, your age or your sex or whatever, and then they also have other information. So if you, for example, hold a different product at the same bank or building society, they'll have information on how you've been performing on that product. They also get information from credit reference agencies as well, so people like Experian and Equifax, who provide data on us about whether or not we have, for example, county court judgments, etc. So all of that data, hundreds of variables can play into these logistic regressions, and the output of it is a predicted probability of default. And because of the history of the modelling in these banks, they usually actually change that predicted probability of default into a score. So instead of being on a scale of 0 to 1, it's actually turned around and put on a sort of a scale of something like 0 to 800, where a low score represents a high probability that you will default, and a high score represents a low probability of default. So you've probably heard about credit scores elsewhere. Now, the way in which these models are measured, the quality of these models is measured with the Gini coefficient. And this is really the sort of where the first problem lies, if you like. So let's start by just looking at a Gini curve. So people might be familiar with this sort of curve, Gini curve, from things like income inequality analysis, where you might have the proportion of which is usually relating to earnings, and you might have, for example, people ordered by their income. So you'd have cumulative percentage of the population along the x-axis ordered by income, high to low here in this example, and you would have the cumulative proportion of total income earned, and you get this sort of shape. In credit risk, it's used, but obviously is represented slightly differently. So here instead we have the cumulative proportion of goods, so people who don't default along the x-axis, and the cumulative proportion of bads along the y-axis. And people here are ordered by their predicted probability of default, or their credit score, if you like. So people with a low score at the bottom left-hand corner, you can see that as we go through that population, the proportion of bads is rising much faster than the proportion of goods. But when we get to the high credit scores at the other end, the gradient's obviously much flatter, and that's capturing where all the good people are with the high credit scores. Now, if a model wasn't working at all well and had no predictive power at all, this line would actually be a straight line from the bottom left-hand corner to the top right-hand corner. And in fact, the Gini value is equal to the area between the diagonal and the curve as a ratio of the triangle in the top left-hand corner, if you like. So the further that curve stretches into the top left-hand corner, the better your model and the higher your Gini value. So in this example, I've got a Gini value of 0.72, which is pretty good. I'll give you a quick quote from a sort of an industry book, which is called The Credit Scoring Toolkit, Theory and Practice for Retail Credit Risk Management and Decision Automation. It's a catchy read. And it says, in most retail applications, scoring a Gini coefficient of 50% plus is more than satisfactory, whilst less than 35% is suspect and 30% possibly unacceptable. In contrast, for behavioural scoring with a one-year outcome window, Gini coefficients of 80% are possible, and anything below 60 might raise suspicions. So this is sort of comparable to a behavioural scorecard that they're mentioning there, and a 0.72 is a respectable outcome for your model, if you like. So that's one way of looking at the power of your model, and it's the way that the banks tend to use. Another way, obviously, would be just to look at the distributions of the credit scores, splitting by the goods and bads, so the people who do default and the people who don't default. So you can see here that the left-hand distribution, the bads, have the lower credit scores, and the right-hand distribution, the goods, they have the better credit scores. This is all coming from the same example. So these are the two distributions that actually went up to make that previous Gini curve. Finally then, one other way that we could look at the predictive power of these models, and possibly the simplest way, is actually to do a two-way table. So this would be more familiar to people coming from a medical statistics background. So this is how you'd usually present, for example, clinical trial results. So with the two-way table then, what we do is we have a two-way of the actual goods and bads against the predicted goods and bads. And in order to get to a predicted goods and bads, what we have to do is set a threshold within our scores. Because obviously it's a continuous score, continuous predicted PD from the logistic regression. We need to split it back into a binomial outcome. So we can find a cutoff within the scorecard, and we can match the observed number of bads with our predictions. So here then, for example, again, this is the same example. I've got 10,000 customers. I've got 5,000 who go bad over the following year, who default. So this is a pretty catastrophic bank, this one. and here the Gini is equal to 0.72 again. So you can see that of the 5,000 actual bads, so just under 4,000 or so are predicted to be bad. So we get what's known as a sensitivity or power from this model of 0.78. So this looks like a pretty good model. I'm correctly predicting most of those bads, if you like. Now, in reality, of course, obviously, the bad rate, hopefully at least, should be much lower. So hopefully the defaults should be sort of around 5% or less, say. And this obviously makes it a lot more challenging for the logistic regression to try and pick out those people. Here I've cut it down to an example with 500 people, and we're keeping the Gini still at 0.72. I'm just going to cut onto the next slide. So if we keep that cutoff, the cutoff that was used in the previous example, the same in order to get to our bad-good prediction, what we find is that in the two-way table, the sensitivity remains the same. So the 386 over 500 is actually the same ratio. I still have a 77% sort of success rate, if you like. The specificity as well remains the same. So that's the predicted, the predictions of the goods over the total goods. It's not a word I want to be using much in this presentation. But there's a problem here. The problem is that if I keep that cutoff the same, the sensitivity remains the same, but you can see that the total number of bads is now massively over-predicting. So I'm predicting 5 times too many. So this isn't sort of realistic. I wouldn't actually use that cutoff. What I'd actually do is find a lower cutoff, and I'd try and match the total number of bads. So you can see in the bottom example that the total bads predicted now matches the 500, and the problem, basically, is that all of a sudden my model doesn't look so good. My predicted bad rate my correct prediction has dropped to 187 out of 500. And so the sensitivity or power of the model has actually dropped to 0.37. Now, in both these examples, changing this cutoff doesn't change the Gini. That always remains at 0.72 here. So this is one of the problems. When they're reporting these Ginis, especially these high numbers, sort of 0.7, 0.8, which if you sort of thought about, say, a multiple R squared sounds pretty good, they're actually sort of flattering the power of these models. Sometimes they're not as good as predicting as we might hope. And the reality is we're fundamentally trying to predict something that's actually very difficult. And one thing that's not captured in these models is unemployment. So in reality, a key driver of whether or not I default on a loan that's made to me is actually whether or not I'm employed. And within these models, we don't actually have the information. The banks don't actually have the information about whether or not you will go unemployed, become unemployed in the following year. So I'm just going to come back to that in a minute. So onto the second problem quickly. Calculating capital, casting our mind back to the sort of time series chart of mortgage arrears, calculating capital is very much a time series problem. Now, logistic regression is obviously a cross-sectional problem, and it's sort of well known in statistics that these relationships don't necessarily hold across both areas. And this is partially certainly the case in credit risk as well. Again, I haven't got a good example I can give you from the credit risk world, sadly, but I can give you another one that's sort of used frequently at our consulting firm to demonstrate this. And this one shows 2 time series. On the right-hand axis in red, we've got real household disposable income over time, and that's indexed at 100%, I think, in 2000. So you can see that real household incomes have been growing in the long term over the last 30 years. On the left-hand axis, I've got the savings ratio, so the proportion of that disposable income that is being saved. And you can see that that's been jumping up and down as we go through the economic cycle, but broadly speaking, it's on a sort of a downwards trend. So if you were looking at these time series things, you might say that there's sort of a negative correlation, or it's certainly not a positive correlation. But if we do a cross-sectional analysis of the same problem, if we actually look at, if we took everybody in the room here, and we took everybody's disposable income and what proportion of it they saved, you'd find that there was actually a positive correlation between those two measures. So there's a bit of a contradiction between the time series and the cross-sectional relationship. And this is a problem also in credit risk. So returning to what I was saying about unemployment being a key driver, which is not incorporated into these logistic regression models, this chart shows the same series that we had before. So it's the mortgage arrears, and that's on the right-hand axis. But now I'm presenting it in differences. So this is the change, the 6-monthly change in mortgage arrears. So when it's above 0, the mortgage arrears are rising, and obviously when it's below, they're falling. On the left-hand axis, I've got unemployment and the change in unemployment in blue. And what you can see is, and they're both set at 0, they both have the same 0 line. So when unemployment is rising, mortgage arrears tend to rise, and when unemployment is falling, mortgage arrears tend to fall as well. There's obviously deviations around on that chart, but it's clear that unemployment possibly is a key driver of actually credit risk in this case. And this is obviously not being captured in those logistic regressions. So what are the conclusions? Well, whilst logistic regression does have its place in credit risk, especially in sort of application type analysis, credit scoring and application, banks obviously don't want to be lending to people who are higher risk. It's not profitable for them, and it might be irresponsible to be lending to them. The use of these models in terms of capital calculation, which is very much an in-time problem, is possibly a bit dubious. And what's very interesting is that going into the recession, some of these models have been seen to be breaking down badly. And in fact, since March of this year, the FSA has started to change the regulation and the way in which these things should be calculated. And they're very much moving now, all of a sudden, towards a more in-time type view of the world. And partly because they've realised the two sort of fallacies that have been spotted, really. There we go. Hopefully that was interesting.
And so there's no statistical inference in this talk. There's a little bit of probabilistic thinking. I still do statistics. I still do a bit of work in multivariate analysis and copulas, which is sort of involved with aspects of this presentation. But this is really about risk and capital, and it's based on a paper that I've written with someone at Edinburgh Business School, Gavin Kretschmar, and with people at an Edinburgh company called Barry and Hibbert. So, you see, there are 3 parts to it. I'll say what economic capital is supposed to be, and then I'll talk a little bit about aggregation, which is one of the critical issues in computing economic capital. I'll say what I mean by a fully integrated model and contrast it with what I consider not to be a fully integrated model, a more modular approach. And then I'll give an example which is taken from this paper I've just mentioned. So economic capital, the first bullet says what it is or defines it. Or it's supposed to be the capital required by a bank or an insurance company, because this concept is common to both, to limit the probability of insolvency to some very small number over some prescribed time interval, such as an annual insolvency probability of 0.0001. But the way the problem is posed, the possibility of insolvency is contemplated, and then the probability is made as small as possible. It's not the same as regulatory capital, because the reason that banks and insurers are regulated is that they're supposed to put capital there to guard against insolvency. But regulatory capital is somewhat simpler. It's based on a set of rules and formulas which apply to all banks and insurance companies. And it's a simplification, whereas economic capital is supposed to go beyond that and to take account of economic realities and give a capital that would ideally prevent insolvency with a certain high probability. Now, Basel II is the regulatory process for banks. Solvency II is the same thing for insurance companies. And this process has what's called 3 pillars. So the first pillar of Basel II, for example, is that you compute regulatory capital according to a set of rules and formulas which are laid out in copious documentation. That's stage one. Stage two is a dialogue with the supervisor, the financial services authority, who then comes into the bank, and the bank gets to discuss its own internal models, which it generally believes are more realistic and more risk sensitive, or that the capital conclusions of those internal models would be more realistic and more risk sensitive than the regulatory capital. And so many companies view economic capital as the response to the second pillar of Basel II. It's what they show to the regulator. The third pillar of Basel II is that a bank then discloses its risks, discloses its capital. Disclosure is the third pillar. So most sophisticated banks will have an economic capital project. Most sophisticated insurers have an economic capital project, building models to compute economic capital. So what is it crudely? Well, so if we use V for value, and we consider a portfolio of assets, which most generally might be the entire portfolio of risky assets of a bank, then we look at the way that VT changes over time. VT is current asset value, VT plus 1 is asset value, let's say 1 year hence. Value of assets can go down, as was witnessed recently, so there can be a loss in asset value. And the idea of how you would compute economic capital is you would apply a risk measure to this distribution of the possible loss in value over a prescribed time interval. So for example, there's a concept of value at risk, which is the risk measure that you apply to the loss distribution is a quantile. You compute a quantile of the loss distribution. So the displayed formula in the middle there, EC for economic capital, var alpha is meant to be an operator which computes an alpha quantile of the distribution of the loss. It's a little bit more complicated than that. You generally subtract the expected loss. So you compute the alpha quantile of the loss and you subtract the expected loss. Banks are concerned about what they term unexpected losses. I find it quite amusing language. They expect certain losses. Certainly in the business of lending, they expect certain losses, and they price those losses into the business when they lend money. They price in the expected loss. But they worry about the unexpected loss, so fluctuations around this mean. And so capital would be set by computing the alpha quantile of the loss corrected by the expected loss. I find the language amusing because to someone who's trained in probability, there'd be nothing more unexpected than losing exactly the expected loss. But anyway, that's the language they use. And this capital, you'd interpret it as being sufficient to reduce your probability of insolvency to 1 minus alpha, let's say 0.0001% over this time period of interest. Okay, why that reduces the probability of insolvency to that level? We haven't talked about liabilities or the entire picture of a bank's balance sheet, but you can go through an argument which illustrates why that would generally, roughly reduce your probability of insolvency to that level. Some people use other measures of risk. So applying a quantile is not the only way of computing a risk measure. There are other measures of risk, things called conditional VAR or tail VAR, expected shortfall. All of these are the risk measures applied to this distribution of the loss or of the mean corrected loss. And there's a lot of academic theory out there about why certain other risk measures, alternatives to VAR, might be better. But for the purposes of this presentation, let's just think about VAR. There was a study in 2007, which came, or at least it was published in 2007, so before the crisis really got underway, which was published by what's called the CRO Forum, Chief Risk Officers Forum, and it was a kind of report on the state of the art of economic capital modeling. And 16 or 17 large banks and 16 or 17 large insurers were asked if they had an economic capital approach or model, and if they were happy with it. And they were all pretty happy with it. And the conclusion was there's significantly increased experience in using economic capital as a process, as a concept across financial services. banks had been doing it for 6 years, insurance companies for 4 years, and they were all comfortable with the accuracy of outputs. So I put that in red, sufficiently comfortable with their economic capital outputs. But of course that was before the crisis, and the crisis indicated that capitalization of banks in particular was inadequate. So one of the issues in computing economic capital, you have to do it at enterprise level. Basically you're wanting to look at the distribution, the change of value of the entire portfolio of risky assets of the bank. But in practice, banks are managed by division. You'll have retail banking. You'll have corporate lending. You'll have different divisions in a bank, and they will do their own risk management activity, and they will look at their own, or they will compute their own distributions, if you like, for the change in value of their portfolio of assets. And so one of the challenges is bringing that together, and that's what this quote says here. Or maybe my introduction to that first. If you look at an entire balance sheet, the fluctuations in the value of assets, they're not perfectly dependent. The assets of a bank are diversified to some greater or lesser extent. And so when you compute economic capital for an entire bank, it would seem like over-conservative to simply compute capital for different divisions of the bank, retail banking, corporate lending, and add them all together. Banks believe that their activities are diversified, so therefore their overall capital should be less than the sum of the standalone capitals for different divisions. But how do you do this? So this is one of the major areas for debate, as the chief risk officers concluded. One of the major areas for further discussion within the industry, the treatment of what they call the diversification effect shows little sign of a single approach holding sway. But there are two broad approaches, and the first is the one which is taken by more or less everyone, that the modular approach is that you compute capital by business unit or asset class and then bring it together by some relatively crude aggregation procedure. So modular, compute capital by asset class and aggregate generally by the use of correlation matrices. I'll show you the formula shortly. This is what more or less everyone does. Some people just add it up, but they worry that means their capitalization is too high. So more often than not, they apply correlation matrices, according to a formula that I'll show you very shortly, to reduce the overall capital with respect to the sum of the standalone capitals for the different divisions of the business. Fully integrated, well, that in contrast would be having one genuine multivariate, multidimensional model for the entire bank, an enterprise-wide stochastic model, which until recently has seemed extremely ambitious, but now there are companies working on this kind of thing. So if we divide the portfolio of risky assets of the bank into D sub-portfolios, D different classes of assets. You'll see examples at the end of this. I better accelerate a little bit. There's a loss in every asset class. So J is the subscript for asset class. And the total loss is just made up of the sum of the losses in different asset classes. So this is the way it's generally done. In each asset class, you compute the economic capital. You apply the VAR principle to the change in value of your assets. You have to work out this loss distribution through a suitable model, stochastic model generally. But once you have it by asset class, you then compute the overall capital by the formula in the middle there, where the rows are some correlations between the risks of these different asset classes. Now you might immediately ask, well, why would you do that? What on earth justifies that? You can justify it. Not many people know exactly what assumptions you need to justify it, but generally they're possibly aware that it would work if the assets of your bank, if they followed a multivariate Gaussian model. So you had a D-dimensional multivariate Gaussian model. That would be the correct aggregation formula that would take you from quantiles of the individual asset classes to quantiles of the overall loss. But it's more general than that. You can justify it. In fact, I have a textbook on this kind of thing, and so you find it more generally that if you're willing to assume that you have an elliptical distribution, that this aggregation formula would work. So if your aggregate losses are linear, or one justification is when your portfolios are all linear combinations of some underlying multivariate elliptically distributed risk factors. But the next question is where you get the rows from. So there are sort of theoretical questions, why would you do that? Of course, the risks of a bank tend not to be perfectly elliptically distributed. But then there are practical questions, where do you get the rows from? Well, they're generally delivered by people who think about these things and then come up with a number between -1 and 1. Then they arrange them in a matrix. If they're clever, they might check that it's a positive semi-definite matrix. Not always, but it's a very approximate procedure, not entirely satisfactory. Full integration, on the other hand, is attempting to build an enterprise-wide stochastic model. So if we consider the losses by asset class, again indexed by J, basically full integration means in some sense a factor model, that these losses are led back to fundamental risk drivers, arranged here in a vector Z, or risk factors. And these are things like interest rates, the so-called term structure of interest rates, the yield curve, or factors which describe the performance of equity markets, stock indexes, exchange rates. It's all the little economic variables or financial variables that drive the changes in value. And because certain of these risk factors impact multiple asset classes, you get inbuilt dependence between asset classes. And that's what drives the dependence between asset classes and the diversification, whether you have a lesser or greater degree of diversification. Just two of those advantages. One, when you build a model like that, you have a way of explaining where the risk comes from and a way of explaining where the dependencies between results in different asset classes come from, because you're relating them in a common factor framework. And the other thing which I like is the ability to actually allocate capital based on these models. It becomes possible to, once you've computed an overall capital, if you have a fully articulated model, you can attempt to break it down and say which parts of the bank are responsible for which contributions to the overall capital. So rather than building it up from individual capital aggregated by crude correlations, you can compute an overall capital and you can break it down. You can disaggregate it into contributions from different parts of the bank. I won't explain how that's done. It's the idea of Euler allocation. Again, it's a piece of theory in this area, how you might break up overall capital into the contributions from different units in such a way that the contributions are sensitive to the different risks run by different units or asset classes. But it's possible to do it. So where you see AC in these slides, EC is economic capital, AC is allocated capital, and if I just take the first formula, it's a way of breaking the total economic capital down into a sum of allocated pieces that measure the contributions. And there is a theory for doing this known as Euler allocation, or allocation by the gradient, which is generally accepted to be at least a fair way of attributing risk. And once you've done that, rather than, you can learn about diversification after the event. You can compute diversification factors. I won't go into that as well. I think what I'll do is just go on to the example to give a flavor of what's possible. But by, okay, maybe just a word about the rationale behind the diversification factors. You can compute an overall diversification factor. That's the economic capital you would assign to the whole bank divided by the sum of standalone economic capitals. And that somehow measures the overall benefit in terms of reduction of capital that these different sub-businesses have by virtue of being part of a larger business. You know, why don't they all operate on their own? Well, by being together, because they're not all doing the same thing, there is a diversification benefit. You can also measure diversification by asset class or by business unit, and that's sort of the benefit to that business unit in terms of reduction of capital that it enjoys through being part of the business or through being part of the whole. So here's the example. So this paper is currently being revised for the Journal of Banking and Finance. Gavin Kretschmar at Edinburgh University, Axel Kirchner at the company Barry and Hibbert. Full integration requires a model. It requires a model for how all these different fundamental risk factors like dynamics of the yield curve and of equities and exchange rates, how they affect value. And that's where the company Barry and Hibbert came in. It's a company that builds models and is based in Edinburgh. But we did an analysis based on 51 banks. You can see that they come from all over Europe, Britain, Germany, France, 51 banks. And you can see that their assets run into billions. So this is based on the published balance sheets of these banks. But if we aggregate them, or if we average them, if we average those balance sheets across 51 banks and call that bank Eurobank, then its balance sheet looks like this. And this is what I mean when I talk about different asset classes. So you have cash as an asset class. You have loans basically to governments. You have loans to other banks. You have claims from corporates, from businesses. You have retail loans. You have residential mortgages, asset-backed securities, etc. These are all asset classes that have their own sensitivities to underlying risk factors. I said that there were experts out there who knew about how these things were correlated. One group of experts are at Standard & Poor's, so they have a matrix, which is their opinions about how these things tend to correlate. Haven't checked it as positive, semi-definite, but that it looks like numbers between 0% and 100%. And this is their view on how you should apply the modular approach. So this is literally done. And the model behind the full integration, well, I'm not going to show. All I'm going to show is a sort of roadmap, which you can't read, I realize, from anywhere beyond the first row probably, which has things like interest rate models, exchange rate models, global market models, parent equity models, macroeconomic factor models, credit models. This is a sort of overview of all the little mathematical finance models that go into full integration. So you have kind of Vasicek models of interest rates, or Black-Kaczynski, I think, is the one that's used. You have a CAPM equity model. You have a Jarolando-Turnbull approach to credit risk. So within each of these boxes is a mathematical finance model that values assets based on fundamental risk factors. And then the final slide, the end result using this kind of model is capital calculation. So the first column is the time zero balance sheet of this Eurobank, just arranged into 6 broad headings. So claims on sovereigns, claims on institutions, retail banking, equity. So broad categories. And then the capital computation has been based on 3 different risk measures, the first of which is value at risk at the 99% level. The other 2 are based on a different risk measure. So just taking the second and third columns, you see the standalone capital computation for each asset class. And then you see that when you add that up, that's the row marked sum, you get a number, 32,000 million, so 32 billions that would be. And so the economic capital additive is that number. Modular is a smaller number. You can deflate that number by applying these correlations in this magical formula. So you can get 25 billion. On the other hand, if you do the fully integrated approach, you get the number at the foot of the third column, which is 30 billion, which lies between the 2. And then using Euler allocation, you can take the 30 and you can go up the third column and you can break it into pieces, which are the risk contributions from different asset classes. And incidentally, it is possible for them to be negative if they're particularly well diversified. I have to stop. I've been a bit of an overrun there. But this is a real debate, how to do this in a sort of fundamental issue in the area. And there's probability behind it. And there is statistical calibration of these models within the roadmap as well, quite a lot of that. So there's activity for statisticians and probabilists.
I realize that's the risk we run when we are close to lunchtime. So I'll try to keep it as brief as possible and try to get my message across at the same time. Today I'll be talking about how to calculate economic capital for a life insurance annuity firm. And this actually comes from a paper that I co-authored with Bruce Porteous, and it is being published in the latest edition of Annals of Actuarial Science. So in this particular talk, we'll talk about how to calculate economic capital for a annuity firm, as I said, and also how a different asset allocation for this life insurance annuity firm can change the economic capital and also the risk-adjusted performance at the same time. So briefly, the agenda is I'll try to introduce what is my definition for economic capital. It will be very similar along the similar lines as Professor McNeil did. And then I'll talk about my model, the underlying engine basically which drives the stochastic model which drives this economic capital calculation. And then I'll take you through the steps very briefly. And then I will introduce the life insurance annuity example. And then I'll show you under different asset allocation strategies how the economic capital changes as well as the returns from economic capital. And finally, I will summarize the findings. Right, so we'll straight away start off with my definition of economic capital. So economic capital is the amount of capital or excess assets, I mean the assets over liabilities of the business, required to ensure the realistic balance sheet of the firm remains solvent. When I say realistic, actually what happened was, historically, liabilities, when an insurance company used to calculate liabilities, they used to put some margins in it so that there's some margins in the reserves so that if something goes wrong, that can be used to meet the claims, etc. But what we are trying to do is make assets and liabilities both realistic. And what capital is supposed to do is to cover the unexpected losses, as Professor McNeil was saying. And so we want a realistic balance sheet of the firm to remain solvent over a specified time horizon with a prescribed probability. On the time horizon issue, I want to mention a couple of things. One is that normally what happens is the regulations, etc., what they say is the company should be solvent over a 1-year period. The definition we use is to ensure that the whole existing portfolio of policies until they run off the books, we continue to trace them. So we calculate our capital requirement based on the whole existing portfolio until they run off the books. Right? And if you look at the definition, it's more like a VAR technique, but essentially there's no reason why we should restrict ourselves to a value at risk kind of framework, because we'll be working with the full distribution. You can actually calculate any risk measure you want. Okay. So this is the underlying stochastic model. It has lots of variables. It has 21 economic variables, 2 demographic variables. So we have around 23 variables which form the underlying stochastic engine, if you want. It is a multivariate GARCH kind of model, so it's a multivariate time series. The biggest problem we have with multivariate time series is the correlations, as Professor McNeil was trying to say, that if we have a 23 by 22 correlation matrix and we are trying to think about how many correlations are more than 200 correlations we have to find out, we try to circumvent that problem using a graphical model approach where we say we set only the correlations for those variables which are connected by the straight lines. So that's the trick, that if 2 variables are not directly connected, we do not have to set their correlations. There's a result from graphical models that says that if you can have a conditional independence of 2 variables, then you can only set those correlations which are directly, those nodes which are directly connected by a straight line. So from these 200 correlations, we have actually brought it down to some 10 or 12 odd correlations. So it's a great dimension reduction technique. Okay, so we'll use this model, and this is our economic capital calculation. So based on this model, we predict our future, we project our future a number of times. Then based on the business, for example, we are talking about annuities. So we'll calculate the cash flows based on these projected scenarios. And for each of these scenarios, we'll determine how much capital we need so that this company remains solvent for the entire duration of the contract. And we perform this calculation a number of times, and we have a distribution of capital requirement at each time point. And based on the probability, the prescribed probability for economic capital calculation, we arrive at the economic capital number. So that's our basic approach. So this is our annuity example. So we have a joint life last survivor annuity. So a couple who are both, say, 65 years old pays a single premium of 250,000, and they will get 1,500 pounds per month until the last of the couple who dies. For the time being, we'll assume our business assets, which is basically the reserves, or if you want the premium that the couple has given to the life insurance firm, is invested in 100% in UK corporate bonds. And for the time being, we'll assume that the capital which the shareholders provide to cover any unexpected losses is currently, say, 100% in cash. Let's see how the economic capital looks like. So we have here, on the horizontal axis, we have the duration in months, so around 55 years, until the end of the mortality table, that is. And on the vertical axis, we have the economic capital going up to 35,000. And what we have, the curves are economic capital for the per policy in force at time 0. What I mean by that is you look at, say, 1,000 such policies, and then look at all these policies as they run off the book. So you can see economic capital at the end of 65 years will be 0 because there are no policies left. But going backwards, can you see at time 0, these are the capital requirements at now when this portfolio of policies is just being sold. So what are these different graphs? The bold line is the regulatory graph, which is the pillar 1 graph Professor McNeil was talking about. And it's based on just some formula. And you can see it is very different in shape from the economic capital graphs, which are based on the quantile or value at risk formulation, which we have defined earlier. And the graphs, economic capital graphs, move upward according to different percentile levels. For example, if you want your company to be solvent 99.5% of the time, you need more capital. But if you want it to be only 95% of the time, you only need less capital. And what we have here is the density of the returns based on the capital that the shareholders have provided the company. So again, the regulatory capital the density looks far on the right side. It's because the same business is being backed by a lower amount of capital. So you can see that the same business being backed by lower amount of capital leads to higher returns, but you should never forget that actually there's a bigger risk that this company will go insolvent. So although the densities are moving to the right, which is good for the shareholder returns, but also these companies can get insolvent much more frequently. So you have to always balance these two facts. Okay? Now let's look at what would have happened if the business assets were invested in shares. I mean, the premium that the policyholders give is invested in shares instead of corporate bonds. You can see the vertical axis now goes up to 200,000 instead of 35,000. So you can clearly see that the economic capital is much larger, all the capital requirements. That's what you would expect, because if you are investing your assets in volatile assets like equities, you need more capital to back your business. So everything goes up, but can you see that the regulatory graph has gone much, much higher? So what actually is happening is the regulators are penalizing equity investment much more than what economic capital should have charged, right? So you can clearly see that companies are not very keen to invest in equities at all, yeah? But at the same time, economic capital also has risen compared to the corporate bonds because of the volatility. I'll skip these density graphs. I'll come back to those density graphs a bit later. Then we started thinking, why just everything investing in bonds and everything investing in equities? Why not club them, mix them, and match them? Then what do we get? Instead of investing everything in equities and everything in bonds, let's try to say 50-50 or 25-75, and then what do we get? So that's where we started looking at mixing things up. And we started asking questions. There are two questions here. One is, suppose a company doesn't have access to a lot of capital. So they will try to minimize their economic capital requirement, right? But suppose, the other question is, suppose that is not a problem. What they want, a shareholder, is to maximize their returns, isn't it? So there are two questions. One is, a capital constrained company would like their economic capital to be reduced. The other is, no capital constraint, I want to maximize my return. So these are the two questions. What sort of mixture, bond equity mixture, will give me this balance? Okay. So what we did was we mixed things up. So we have everything at 99.5 percentile level. So the probability of insolvency is the same in all graphs, but there are starting from this graph, the bold graph, it is 100% in bonds. Then this graph is 75% bond, 25% equity. This is 50% bond, 50% equity, and this is 100% in equities. Clearly, 100% in equities means a lot of capital requirement. So capital constrained firm will not go anywhere there, anywhere there, anywhere there. But what about these two? You can see that this one is much below this one, although it starts off slightly higher. So you can see a 25% equity investment along with 75% bond actually is much better than investing everything in bonds, because the capital requirement is much lower. Okay? Then on the return graphs, it's also very interesting. This is where 100% in bonds. This one is, actually I'll show you the best one. This is the dotted line that you can see. That's the density absolutely on the right. That's where the 50-50 thing is there. 50% bond, 50% equities. So what it's saying is, if you invest 50% bond and 50% equities, your economic capital will be there. But if the shareholder is willing to put that much amount of capital into business, then their return graph will be much farther on the right. So there's a higher probability of greater returns, right? So traditionally what has happened is the annuity firms have had knee-jerk reactions. For example, in the 80s when equities were doing too well, everything in equities. Suddenly everything doing badly, everything is in bonds. It shouldn't be like that. You know, they should have proper risk management techniques. They should do this kind of analysis. Then they can actually come up with the right amount of mixture that they can actually invest in. If they have capital constraint, then probably a lower mixture with lower equity content, but they want greater return, a little bit more equity investment that might be required. But what is absolutely critical is to ensure that they do this kind of risk analysis before they take these decisions. Okay? Thank you. That's all.